4,800. Watch it on the S&P because it's been a minute. We haven't been above that since January of 2022.
That's
just
correct.
Shows you this run that we've been on, the momentum that we seem to have back. And the question, as I posed at the very top, how far can we go?
Keep playing offense. That's what I believe. That's what I see as we move into the month of January. Play offense and the broadening out of the market. The Russell is strong once again today. In fact, you actually have energy, which we'll talk about later in the show, in which the momentum seems to be building to the upside for a breakout. That's what I'm seeing. But it's about the market right now understanding that yields have pulled back aggressively. And Scott, once they got below 4%, you asked this question a couple of weeks ago, what happens when they get below 4%? Well, I'll tell you what, they've gotten below 4% and they've stayed below 4%, which is interesting.
I think is the 10-year today.
Yeah, so we never really saw the bounce. You know, you figure you would see a break below 4% for a 10-year, and then you'd see subsequent to that a little bit of a bounce. You haven't had that. So staying below 4%, that's a good indicator for risk.
Yeah. Is that how you see it as well, Bryn?
I mean, it seems what Joe's saying is spot on. I think that this is one of the strongest 7 days of the year, starting last Friday. And then we all know, as the first week of January goes the first month, that sets the tone for the first year. I will say it feels a little reminiscent to 2017. We had more volatility this year, but remember, going into the first month of 2018, the S&P was up 5.5% or 6%, and then, boom, back in February, gave about half of it back. So I feel like we're setting up with a replay of that. I do think that the market is a little bit at odds with the Fed. I don't buy into the 6 or 7 rate cuts. I think that's just too aggressive. So I think dance while the music's playing. But I think as we get closer to March, which feels really long, really far away, I think that the market's going to come to the realization that we're probably not going to get a rate cut that soon, and then that can give us an opportunity for some sell-off.
I'll tell you what, Weiss, we had a former Fed economist on Squawk on the Street earlier with Sarah and I, and she made the point that the last mile is going to be the easiest, whereas I think that's a little counterintuitive. People think the last mile of getting inflation to target is going to be the hardest part. If she's right, this former Fed economist, then what does that mean for markets?
Well, it means that the market's going to perceive that you will have those 6 rate cuts. I'm in the camp that you're not going to get them either because they want to make sure that there's staying power to low inflation. Because don't forget, you've got massive government spending, and you've had a real massive easing of financial conditions with, as Joe pointed out, the 10-year coming down and other rates coming down. So look, I think, for this week, so for the next 3 days, it's clear sailing, no real data to think of. Then as you get into January, then it's going to get a little tougher. The questions are going to be, what are earnings going to look at? Are we going to have more types of a FedEx or a Nike situation? Stocks that did very well, particularly Nike did well in the last couple of months. FedEx had a good year until they didn't.
Well, see, this is a good point you make because, earnings are only expected to grow 5%. You take out energy, it's a little higher than that.
Right.
But so many stocks have been up so sharply in a short period of time. What does that do to the earnings bar?
It makes it higher, right?
Raises it up.
Yeah, without a doubt. So you've had massive multiple expansion in this market. That's really what's driven it, not the earnings growth. And also what's driven it is the multiple expansion. Nobody goes in and says, I look for this multiple to expand. What they do is they say, hey, the Fed's going to be cutting at some point. That narrative is still going to continue. So that's really the conundrum, right? If earnings season disappoints, does that mean that the Fed's going to cut sooner? That's going to be the perception. So I think either way, you're sort of okay in the market, but it's going to be critical where you are. So I still think mega cap tech is going to do well. Others will do well. You'll see the market continue to broaden. But the biggest thing getting in the way of the market right now is what I just said, that everybody believes there's no bear case.